Paul, I wanted to start with a heartfelt thank you to our viewers. I don't know if you guys know our journey. If you're new to our channel,
our journey.
Paul and I have been doing this, obviously making absolutely no money. And if you look around the studio, Paul has invested a gajillion dollars into this education platform. We started this because there's no other way to say it, Paul. After your 20 businesses, which go up, which fluctuate up and down as you buy and sell, you sort of got bored with life a little bit, but you've been an educator and educating younger folks on investments for many, many years now. And that was the
our old high school, right?
Yeah, and this was the basis of this channel. And so over the past month, we'll be dead honest, it took us about almost 2 years to get 500 subscribers, to the point where some of our dear friends were saying, why are you idiots doing this? You're making videos.
Your dear friends.
You're making videos that get 17 views. But in the past 30 days, we got upwards of 650, 700 subscribers, which to us might as well be 1 million. So I wanted to start with a very heartfelt thank you for following us. If you're new, all you have to do is smash that like button in the bottom right corner. And if you want to subscribe, we'd love to have you. Join the community that we're forming of learning from a guy that, Paul, you're absolutely one of the most successful guys I've ever met. You've changed my life.
Adorable.
All the money you make and all the businesses that are successful and the cars you drive me around in and the sushi dinners you take me to. This can all be yours. This can all be yours. All you have to do is press the thumbs up. But that's not why we're here, Paul. Off the request line, someone said they wanted you to take your 8 pillars of investing in a stock and look at fun. Now, what is fun?
Who asked for this?
I don't know.
Do you remember?
So Cedar Point is the most amazing place on earth, second to Disney, and it's located in Sandusky, Ohio, which is very near and dear to our heart because we're about, an hour away, less than
an hour away, and it's arguably the best amusement park in the world, right?
That's what they say. I guess if you say it enough, you are. But yeah,
no, I think they really. they added a lot of rides.
You're right. They got all the rides.
When was the last time you were there?
No, I'm not a big roller coaster guy. My kids are. My wife cannot wait to take them to Cedar Point. But let's talk about this stock. Tell me everything you know about this stock.
So the reason we're looking at the stock right now is, how many people do you think have been to Cedar Point this year?
Oh, yeah. Great question, Paul. So the answer would be absolutely none.
I would imagine so.
And so as you can see, who's dinging? Is that you, Paul?
Oh, is that me?
As you can see, the stock is in the tank at the moment. And as I always say, this looks like it's on sale. Is now the time to buy. Paul's going to look at the 8 pillars to see the health of this company. Go ahead, Paul.
So if you see, like a year ago, it hit $60 a share. It's currently selling at $28. Now, as we always say, we don't care what the share price is.
Right.
But the reason we're looking at it is whenever you see a big drop like this, I mean, it got as low as $13, $14. Mm-hmm. That's an 80% drop, right?
Amazing.
75% drop. So the reason we're going to look at this now is say, okay, is this an opportunity to buy?
Yes.
So let's start with our good old financials.
Well, pillar number 1 is PE ratio less than 20. But this one's tough, Paul, because
here's what we're going to look at with this stock.
Go on.
We're going to look at how this stock did before COVID.
In a normal time.
Yeah. I'll still intersparse, or is that what it is?
That was a great word. Great,
whatever.
Great, Paul.
Current financial data, just to show how bad it is, as a way to see, should we be looking at it right now?
Okay.
So right now, the PE is 0.
Right.
It's negative. And the reason being is this PE looks at the last 12 months. Well, the last 12 months have been 6 months of the last 12 months have been absolutely terrible, right? Mm-hmm. So we're going to look at this right now based on the previous full year's data. So the PE, right now the company is worth $1.6 billion. If you wanted to buy it in full. The last full year, 2019, it made $172 million, okay? So to get the PE, you take the current price, $1.6 billion, and divide it by the current profit, 172. What is that, 9?
Yeah, 9.3.
Okay, 9.3.
Yeah.
So right now, if the company were to go back to last year's profit, this would be a good number. We'd have a green check right here.
Green check.
Okay, now I really want to make sure we focus on the fact that this data is based on last year's data before COVID.
Mm-hmm.
Right now, it does not make money. Let me show you, and I want to show you that. I do want to show you what I mean by that. Let's pull up the last 12 months. So the last 12 months data, trailing 12 months, will include the COVID time.
Okay.
The last 12 months, they did $1 billion in revenue. They lost.
Use your marker a bit.
They lost in the last 12 months $155 million. Okay, so you got to remember that when considering this. It's not the end of the world. You can still buy stock in a company that's losing money. If look at Carnival Cruise Line's losing money, and I still bought some, right?
Yes.
So the same thing here, but just to keep that in mind, Cedar Point Fair, Cedar Fair fund stock did lose money in the last 12 months. Okay, next one, profit margin.
Profit margins, pillar number 2.
Okay, so let's go back to a normal time. And last year, the last full year, they did $1.5 billion in revenue, right? 1.475 and profit of 172. So to get profit margin, you take 172 million divided by 1.475 billion. What is that, 11%? 12%?
I can't do the millions and billions so fast as you.
It's not, you just take the zeros off.
Oh, thanks.
Just take the zeros off, right? They both have 3 zeros, just take them off.
Well, yeah, you're very smart. I'm just
I don't know if
some
that's very
guy.
smart. I've been doing it for a long time.
See, there you go. 11.6. You're right.
12%, 11.6. So again, in the last full year, if you buy it, if you were to buy it based on the last full year's price, we have another green check mark here. Profit margin being in the positive. We're being over 10%.
Wow. Okay, great.
Okay, let's go to revenue growth.
Pillar number 3, revenue growth over the last 5 years.
Well, here's the good news, Sethi.
What do you got? I can see it a mile away.
1.24, 1.29, 1.32, 1.35, 1.48. And even better, look at the previous 5 years, 1.16, 1.13. It's consistently, last 10 years, we've had growth every single year.
Boom, green check.
Green check.
Profit growth over the last 5 years.
Okay, so now we slide down the financial statement. Okay, 112, 178, 215, 127, 173. So it is up, right?
Up, yes.
It is a little choppy, which we've seen a lot in the last 5 years for a lot of companies. Have you noticed that?
Yeah, and especially 2 years ago.
Yeah. I don't know why that is. But these are some of the things that you do more detail. Why do they have a big drop in 2018 from 215 down to 127? Or was this big jump some reason, like some off reason?
So this might be something you would look into further.
Yeah, further.
But
still green check mark here.
Boom, 4 in a row. How about number 5? Number of shares outstanding. We want that decreasing over as time progresses, Paul.
Okay. 2010, 55 million, 55, 55, 55, 55, 55, 56, 56, 56, 56. So very slightly up.
Okay.
This is I'm going to add something to the situation. I want to call it like an equal sign. It's neither good nor bad. It's just whatever. This isn't bad. I'm not going to sit there and say, oh, this is terrible. It's up. Let's give it a red X. I mean, clearly it's not really what we want. If anything, I would err on the side of green check, to be honest with you.
So would you say, when you say it's equal, is it equal like, meh, who cares, or meh, it doesn't matter? This
growth of 1 million shares over the last 10 years is a 2%, not even a 2% increase in the number of shares in the last 10 years. I don't care.
Okay.
To me, this is more of a green check than a red X. This is more of a, hey, listen, there's probably a reason why they have a million extra shares outstanding.
The next pillar number 6, is current assets greater than current liabilities.
Okay, so balance sheet. We're going to go to the annual first. So again, the last full year, the current assets were $295 million. The current liabilities were $324 million.
They're upside down.
So they're upside down there. But let's go look at the previous history. 200 versus 234.
They're always upside down.
247 versus 225. So they're positive there. 195 versus 242. So it seems like they're pretty much upside down all the time.
Okay.
When I did a search the other day on S&P 500 companies, about 70% of them have more current assets than current liabilities currently. So it's not all of them.
Okay.
And the ones that were in the 30% that weren't, it wasn't like I looked at the list going, oh my God, these are terrible companies. That just could be their business. If we're going to have a red X on any of them, I'm really fine with this one and the number of shares outstanding. Like the way we saw it here, which was very slightly up. So this is a red X, but it's not the worst thing in the world.
How about free cash flow, pillar number 7? Cash from operations minus capital expenditures, Paul.
Can we do one more thing?
Sure, please do.
Let's go to the quarterly look, the most recent quarter on the current assets. Actually, you know what? I don't care about that because I mean,
They're
it's
going to be bad, right?
Well, yeah, 415 million. It's actually really good versus 231. So currently, they probably raised some debt to make sure they can cover their bills. So they have way more current assets and current liabilities as of this very second.
Okay.
So this one actually, you can make the argument it's a green check right now, but because of the way current is. But they probably took on a lot of debt so they could withstand this downfall.
Okay.
Now, free cash flow. Seth, I have a question for you.
Go on.
What is free cash flow?
It's cash from operations, meaning how much money they have on hand.
No, but go ahead.
Oh, what does it mean?
Cash from operations is the cash they generate from operating their business.
That'd be nothing right now.
Yeah, but we're going to look at the last full year.
Okay, go on.
Okay. Less their capital expenditures. So a company like Cedar Fair has a lot of amusement parks. I would guess they have a lot of capital expenditures. Putting in new rides, upgrading safety, putting in new stands, games, things like that.
Yeah.
And I think it's pretty evident they are. Okay. So the last 5 years, 170, 190, 143, 151, 70.
This is free cash flow.
This is free cash flow. It's their cash from operations less their capital expenditures. Use free cash flow to pay dividends, to invest in other things, buy other companies, etc.
Uh-huh.
It's kind of going the wrong way.
Mm-hmm.
Right? So we'd want to understand why. Let's go to the previous years. You have 110, 120, 290, 200, 170. So it was going up for the previous for the first 5 years of the decade, and then going down for the other part of the decade. This is something I definitely want to understand. Like, why last year was so bad? Why did they only have $70 million in free cash flow? Their capital expenditures skyrocketed. It almost doubled last year. Now that could be a very explainable reason. Like, you know what? We went and did this, this, and this, and this, and it's going to increase. And when you read the 10K, it'll tell you why their capital expenditures jumped up so much. They could have put some major improvement in one of their parks or put a few rides in, and it's going to make them a ton more money.
Check or X on this one, Paul.
We're going to go X on this one. And this is a big one for us, but we're going to go X on this one.
Price to free cash flow. Pillar number 8, the final pillar. Price to free cash flow.
So,
less than 15%. Less than 15.
I'm gonna audible on this one.
Go on.
I'm not going to go off last year only, and the reason being, it was such a random amount, right? So what I'm going to do here is I am going to take an average of the last 5 years. Okay? Mm-hmm. So what's the last 5 years? 230 and 140 is 570. 370, 560, 730. So 730 divided by 5.
146.
146. And they're currently selling for 1.6 billion divided by 146. 11 again?
10.9.
Okay, 11. So the price of free cash flow, whenever you have, and by the way, this is a very common thing. Sometimes you might want to take the average when you see these jumps up and down. When you see these big jumps and these big non-consistency, you want to maybe take the average of a 5-year period and look at that. Now, when you do the average, if it's increasing, you want to take the average will be lower than the most recent year, so you might be willing to go higher than 15. But the whole point is, I'm sitting there saying, like, listen, last year's one-off, like, if, for example, if all of a sudden this had been 370, would I have counted 370 as the regular price of free cash flow? No, I'd been like, okay, well, wait a second. I can't really include that because it could be some random reason. So I take the average of the last 5 years. And by the way, we might want to change this pillar to be, maybe it's price to free cash flow less than 20 over the last 5 years. Mm-hmm. I'm just sitting there saying, like, a lot of times you want to look at, this is why we look at history. Is this a consistent number? And clearly last year was not a consistent number. So I give this one green check.
That is a total of 6. Let's see. Did we do 9 of these? How did we get? This is no, I see. We did 5 green checks. We have a meh on shares.
I would still consider that more of a green check than a red X.
Okay.
So call it 5.5 out of 8.
So free cash flow is down. Asset liability is.
But here's what I'll say. Look at our income statement, guys.
Go on.
This is the problem we have. Last year, in 2019, in the second quarter of 2019, they did $436 million in revenue.
Come on.
Look what they did this year.
$6 million.
$7 million in revenue. That's down 98.5%. They haven't had anybody.
What's that tell you about this?
So the big thing about this stock is, are they going to be able to withstand this shutdown? Mm-hmm. Just like we looked at with Carnival, just like we looked at with Love, with Southwest Airlines. All of these is about, can they withstand it? That's why we looked at their recent quarter, current assets versus current liabilities. They have $200 million more. You want to understand, you want to go do research in this company, find out what they're doing to make sure they withstand this. Now, I will say this. Mm-hmm. I don't like the price for the fact that they've lost 98% of the revenue. Yes, the revenue will come back, but I think it'll be a slower comeback than everybody might think. So I'm looking at this saying, is 10 times profit and 10 times free cash flow enough of a discount for me to buy Cedar Fair? I don't personally believe so. Mm-hmm. But before you make that decision, you need to go do a lot more research, read the 10K, go maybe listen to a couple recent investor calls where the CEO and the CFO talk about the financial health of the company. Even if it's great, I look at it saying, this company is going to have losses for an extended period of time. Is 10 times their most recent year's profit enough of a discount to go buy the company?
I mean, we're entering winter, so they shut down at some point here for the winter anyway, at least this Cedar Point. So
I will say this.
Go on.
They didn't really increase the number of shares by a ton in that time period. So I like that. They're not issuing shares, probably it's hard to. They're not issuing shares to fund their losses. I like that a lot. They're probably taking on debt is my guess. They have to. And you're saying something about winter. Yeah. First off, Cedar Point is going to be shut down. I mean, it would be shut down next week anyhow.
Yeah, well, I think they shut down by Halloween, but still, yeah, something of that nature. Yeah. So
yeah, you're right. Halloween maybe.
We're going 4 months with like not even allowing someone to walk through the doors.
Correct. Yeah. Look at this. Look at their long-term liabilities. They've jumped up a lot in the last 2 quarters. 2.2, 2.3, 2.3, 2.3, 2.5, 2.8. So they're taking on more long-term debt in order to fund their losses. Again, could you end up hitting a home run? To me, a half discount for a company that lost 98% of their revenue without knowing when they're going to be back, it's not enough for me. Like, to me, Carnival Cruise Line is a better bet. Southwest Airlines is a better bet. People are more likely to be travel. Travel is a requirement for business people. This is completely discretionary, right? And Cedar Point is not cheap. How much does it cost to take a family of 4 to a nice amusement park?
Hundreds. It's $100 a person. It's like Disney.
Yeah, so you're looking at saying, I don't look at this as a big enough discount for me to be like, yep, I like this. But it's not where I'm sitting there saying, this is definitely on my radar to watch. Now, they got as low as we saw. How low did it get, Seth?
You said $13 or something.
Something like that, right?
Yeah.
I mean, that seems like a discount enough to me. Mm-hmm. Like, to me, I was thinking to myself, I'd want to see half this price.
So what? Can you go back a bit? Like, how high did this puppy get? Oh my goodness. Okay.
Yeah. So its high was around $72 maybe.
So are you saying, does this ever cross your mind that like it's exactly half of its height? And that's not enough considering the numbers are so in the tank.
What I look at is how low did it go as a way of me understanding, could it go low? Look at this. In 2010 recession, here's the other thing.
Go on.
In the 2009-2010 recession, it went lower than it did in March, and there was no shutdown back then, guys. So that to me might be an indication going, well, that's weird. There was no shutdown, and in 2009, even though the recession was bad, let's go look at their financials in 2009. Let's see how much they fell in 2009. That's actually a good thing to look at. Because we had a bad recession in 08 and 09, right? Mm-hmm. So let's go previous periods.
While Paul's pulling this up, make sure you smash that like button in the bottom right corner. We super appreciate it. We appreciate the support.
Not even appreciate it. You guys need to do it.
That's true, Paul. It's very nice of you if you could. We love you out there. Thanks for listening.
We need 20% of our people hitting the like button. What are you laughing about, Don? You need to do it. Guys, we're giving you stuff for free. Just hit the like button. That's all I'm asking. Hit the stupid like button, subscribe to our channel, and you get this stuff for free. It's very simple.
It's true.
I mean, that's all it is. I was just telling you last night, like a lot of these YouTube people, create products to try to sell. We're not trying to do that. We're sitting here saying, listen, we want to make this as free as possible.
Yes.
But I got to be able to pay Don and Seth more. So if you look at the 08-09 recession, they dropped in revenue, but by how much? 8%?
Wow.
8% drop in revenue?
Resulted in that much stock?
And the stock went to freaking
yes.
How much? But we didn't even get that low in March when the company was shut down completely. So I'm looking at saying I would watch the stock for the next downturn in terms of the next stock downturn. This might be a good opportunity at some point because it also has 50% more revenue than it did back in 08 and 09 when it stabilized.
Yeah. So
this is a good stock to keep your eye on. I don't think it's a buy, say, at $28 a share at a $1.6 billion. I think you have to wait a little bit and hopefully you'll get a better buying opportunity. But again, everything is different. Like things can go crazy. I mean, who would have thought that it would jump up this much? That's the way I look at Cedar Fair. I mean, look, it got as high as 30. What is that? Is that $40 a share almost?
Yeah.
That's almost $40 a share.
Wow.
I mean, maybe. I think that's not. Look at that revenue. 98.5% drop in revenue.
Wow.
Did they pay dividend? They used to. They cut their dividend. Look at that. They used to pay dividend. They cut their dividend.
Wow. Incredible.
Yeah.
Thank you, Paul, for the insight on fun stock on Cedar Point. Thank you for our watchers out there for the Everything Money channel. Make sure you like and subscribe. And we've done hundreds of videos. Look back if you want to hear about stock analysis of Apple. Did we do Disney yet? We should.
Did we do Disney yet, Don?
I don't think we gave it a full, deep analysis.
We should. Okay. We should because I just want to see the thumbnail picture of you.
That's exactly it. And Don, that was a great thumbnail picture of me with the hat on.
Check out our most popular video.
I look like Gilligan.
A couple weeks ago on Carnival Cruise Line, which Paul bought, Seth bought, Seth's 10-year-old son Gio bought, and we're stoked about it. And yeah, all right. Thanks for watching, guys. Love you. Thanks so much.
Guys.